Most investors believe they are managing risk, when in reality, they are playing a completely different game that they do not even realize exists. When you look at a wall of stock tickers, financial spreadsheets, or probability models, everything looks precise. Everything looks calculated. You see numbers like volatility, beta, historical drawdowns, and standard deviations. And your brain tricks you into a comforting illusion. You tell yourself, if I can calculate the odds, I can control the outcome. But legendary investor Howard Marks discovered a terrifying truth early in his career. A truth that separates the people who lose everything during a crisis from the quiet billionaires who profit from it. The market does not fail because people fail to calculate risk. The market collapses because people confuse risk with something far more dangerous: uncertainty. Think about that for a second. Risk is a game of roulette. You know the exact number of pockets on the wheel. You know there are 38 slots. You know precisely what the odds are of hitting red, black, or zero. You might lose your money on any given spin. But the math never lies, and the probabilities are absolute. That is risk. Uncertainty. Is waking up to play a game where nobody told you the rules. The wheel has an unknown number of slots, and someone might change the shape of the table while you are placing your bet. Most people allocate their life savings, their pensions, and their future, assuming the financial world is a game of roulette. They think if they just study enough historical charts, they can predict what comes next. Howard Marks built Oaktree Capital into an empire managing over $180 billion by doing the exact opposite. He realized that the grandest financial catastrophes in history did not happen because people took calculated risks. They happened because people were completely blind to uncertainty. So why do even the smartest investors on Wall Street constantly mistake one for the other? And more importantly, how can understanding this single hidden distinction protect your wealth when the next invisible crisis hits? To understand how this dynamic works, we have to travel back to a moment when the world's most brilliant mathematical minds thought they had finally solved the stock market. In the late 1990s, financial modeling reached its peak. Quantitative analysts, the math prodigies from MIT and Harvard, built algorithms designed to predict market behavior down to fractions of a percent. They looked at 50 years of market data. They ran millions of simulations. They calculated the risk of every asset class down to the fourth decimal place. They believed they had turned investing into pure science. They felt completely safe. Then, something happened that was not in their spreadsheets. An event occurred that had zero historical precedent in their models. In a matter of days, systems that were calculated to fail only once every 10,000 years completely disintegrated. Billions of dollars evaporated into thin air. When Howard Marks analyzed these failures, he noticed a fascinating psychological flaw in human nature. When human beings are given a spreadsheet filled with data, we feel a false sense of security. We mistake data for foresight. We believe that because we can measure the past. We can predict the future, but as Marx famously observed, you cannot predict, but you can prepare. When you measure risk, you are looking backward at what has already happened. You are assuming that the future will look like a rearranged version of the past. But uncertainty is about what has never happened before. It is about the black swans, the geopolitical shocks, the sudden shifts in human psychology, the unexpected technological disruptions that no historical chart could ever reveal. When an investor calculates risk, they ask, what is the probability that this investment goes down 10%? When a master investor like Howard Marks navigates uncertainty, he asks a completely different question. If something completely unimaginable happens tomorrow, can this business survive? Notice the subtle shift in thinking. The first question relies on prediction. The second question relies on survival. This brings us to one of the most profound paradoxes in behavioral finance: the illusion of control. When the economy is booming, everyone feels like a genius. Prices rise, credit is cheap, and profits look effortless. During these times, investors begin to believe that risk has been permanently reduced. They take on more leverage. They stretch their balance sheets. They buy overpriced assets because this time is different. They mistake a rising tide for their own cleverness. Howard Marks calls this the pendulum of market psychology. At one extreme, when optimism is high, investors act as if risk does not exist at all. They look at uncertainty and dismiss it as a temporary minor inconvenience. Then, the pendulum swings. A surprise shock hits the system. It could be an unexpected rate hike, a corporate scandal, or a global crisis. Suddenly, the illusion of control vanishes. Investors realize they never actually understood the uncertainty they were facing. Panic sets in. The exact same people who were recklessly taking massive risks a few months ago now run for the exits. They refuse to invest at any price. They flip from total overconfidence to total paralysis. And here is where the master story unfolds. Because inside that moment of mass panic lies the single greatest secret of wealth building. Howard Marks points out something deeply unintuitive about risk and uncertainty. The safest time to invest is often when the world feels the most uncertain. And the most dangerous time to invest is when everything feels completely safe. Read that again in your mind. When everyone believes the future is certain, prices soar to perfection. Every asset is priced as if nothing can ever go wrong again. That means you are paying a massive price for zero margin of safety. When safety is assumed, real risk is at its absolute highest. Conversely, when the world is engulfed in uncertainty, nobody wants to buy. Asset prices collapse. Businesses are sold at deep discounts simply because people cannot see what the next 6 months look like. The prospective returns jump through the roof, precisely because uncertainty has driven everyone else away. Risk is not an objective property of a stock or a real estate property. Risk is a function of the price you pay for it. If you buy an incredible business at an inflated, perfection-priced valuation, you have taken on immense risk, even if the business is great. But if you buy a decent business at a price so low that it assumes total failure, your risk is remarkably low, even if the surrounding environment is deeply uncertain. Most people spend their entire lives trying to eliminate uncertainty. They want guarantees. They want clear forecasts. They want financial commentators on television to tell them precisely what the market will do next quarter. Howard Marks realized a fundamental reality. The market forecasts you hear every day are not just useless. They are actively dangerous. Predicting macroeconomic movements accurately over long periods is statistically impossible. There are simply too many chaotic variables: human emotion, political decisions, unpredictable innovations, natural events. If your investment strategy relies on someone accurately predicting the future, you are taking on unmeasurable uncertainty while convincing yourself you are managing risk. So how do the world's greatest investors navigate a world governed by uncertainty without going crazy or going broke? They build what Howard Marks and Benjamin Graham call a margin of safety. Imagine a bridge engineered to hold 30-ton trucks, but the city authorities only allow 10-ton trucks to cross it. Why do they do that? Because they know the bridge might deteriorate, an unusually heavy storm might hit, or a driver might bring a truck that weighs slightly more than advertised. That 20-ton difference is the margin of safety. It is a deliberate buffer designed for an uncertain world. In investing, a margin of safety is not just a calculation. It is a philosophy of humility. It is admitting to yourself, I do not know what the future holds, so I will structure my investments so that even if I am wrong, I will still survive. It means demanding a low purchase price relative to intrinsic value. It means avoiding excessive debt that forces you to sell during bad times. It means holding cash when asset prices are ridiculously inflated, even when everyone around you is getting rich faster than you. It means investing in businesses with durable competitive advantages, companies with pricing power, high switching costs, and strong cash flows that can endure prolonged economic winter. When you invest with a true margin of safety, you stop trying to be a prophet. You stop stressing over macro forecasts. You stop worrying about whether the market will go up or down next week. Instead, you position yourself like a fortress. You accept that bad weather is coming eventually. You just do not know when or how hard it will blow. When the storm finally arrives, and it always does, The investors who mistook risk for certainty are wiped out because they built their houses on the assumption of sunny days. Meanwhile, the investor who respected uncertainty sits calmly in their fortress, waiting patiently for the panic to create the generational opportunities of a lifetime. Ultimately, the hidden difference between risk and uncertainty comes down to a simple, life-changing shift in perspective. Risk is about asking, how much money can I make if I am right? Uncertainty is about asking, what happens